2009. A small investor buys a stock, Clean Energy, the future, a company making solar panels at exactly the moment the world is desperate for them. He isn't gambling, he's researching, he reads everything, he tracks the sector. He makes what feels like an informed decision. 2 years later, he's lost almost everything. And here's the thing that should keep every investor up at night. He wasn't wrong about the company. The company was real. The technology was real. The demand was real. The story he believed was, in almost every way that mattered, true, and he still lost almost everything. Now here's the question. What exactly did he miss? Because at the same moment, looking at the same company, a professor in New York arrived at a completely different conclusion, not because he had different information, because he asked a completely different question. The market was pricing that stock at $2.70. He said it was worth 42 cents. Same company, same story, same moment in time. Two completely different questions, two completely different answers. This video is about the question the professor was asking, the one most investors never learn. The one that changes everything. Here's something nobody tells you when you start investing. The price of a stock answers one question. What is the market willing to pay for this company right now? That is a useful piece of information. It tells you what the crowd thinks, what the mood is, what the consensus happens to be this morning, but it tells you absolutely nothing about what the company is actually worth. Those are two different questions. And for most of history, most investors have only ever learned to ask the first one. The question this video is about is the second one. What is a company actually worth? Not what the market thinks today, not what an analyst wrote in a report, not what it was trading at last year or last month or last week. What would this business produce in real cash over the rest of its life? And what is that production worth right now, given how certain or uncertain that future actually is? That question doesn't have a simple answer, but it has a discipline. A way of looking that forces you to see things a price never shows you. 7 companies, 7 moments, 7 times the same discipline revealed something the market was missing, or something the market was right about that everyone else refused to see. By the end of this video, you will have that discipline, and you will understand why the investor who lost everything wasn't wrong about the story. He just didn't know what question to ask. The professor asking that question is Aswath Damodaran. He teaches valuation at NYU's Stern School of Business. Wall Street calls him the Dean of Valuation, not as a courtesy title, but as an acknowledgement of something real. Generations of analysts learned how to value companies from him. His thinking runs quietly underneath a significant portion of the investment decisions made in this country every week. He has written books on valuation that sit on the shelves of professionals at every major bank. This one is different. He called it the Little Book of Valuation because he wrote it for everyone else, not for people who already speak the language, for anyone willing to ask a better question about a price they're being shown. The book is built around real companies, at real moments in history. The math is present, but the math is always in service of one idea. Every company has a value you can estimate. Every price has a gap between what it says and what reality says. And learning to see that gap, really see it, not guess at it, is what separates an investor from someone who is simply following the crowd. He wrote this book because he kept watching the same mistake repeat itself, not from beginners, from professionals, from people with 20 years of experience and billions of dollars under management. They knew how to read a price. They didn't know how to find a value. He decided to show them. He decided to show anyone. Before the case is one idea. Everything else in this video is built on it. Think of any company. Strip away the brand, the ticker symbol, the story and the headlines. What is an investor actually buying? Not the name, not the momentum, not the feeling that this one is going to go up. A claim on future cash. That's it. Everything else is packaging. The question, the real question, is what that future cash is worth. And the answer depends on exactly 3 things. How much cash the business will actually generate, how fast that will grow, and how certain you are that any of it arrives at all. Cash flows, growth, risk. Those 3 things are the entire conversation. Every number in evaluation traces back to one of them. Every mistake in evaluation can be found by asking which one was handled dishonestly. The price is what the market feels today. The value is what those 3 things actually add up to. That gap between the feeling and the math is where this video lives. September 2008. Lehman Brothers collapses. The global financial system shudders. Markets are in free fall. Everything looks cheap. That's what the moment felt like. Stocks down 40–50% from their highs. The instinct for millions of investors was, this is the moment. Buy. But buy what? And at what price? Cheap is a comparison. Cheap compared to what? Compared to last year's price? Sure, but last year's price might have been wrong too. The question isn't whether something fell. The question is whether what it fell to is below what it's actually worth. And to answer that question, you need a number that isn't the price. Damodaran sits down and values 3M, boring, diversified, industrial 3M, the company behind Post-it notes and surgical tape and safety equipment. Not because 3M is exciting, because 3M is the perfect test case. Stable enough that the three pillars, cash, growth, risk, give you a clear answer without too much noise. He does the work. 3M was worth $86.95 per share. The market was charging $80, $8, less than 10%. In the middle of a crisis where markets had fallen by almost half, he walks away. He doesn't buy. Not because the number was wrong, because 86, 95, and 80 are close enough that the margin of error in his own thinking could easily explain the difference. The work wasn't telling him, obvious bargain. It was telling him, roughly right, small lean, toward cheap. Not enough. And that is the first thing this book teaches. The thing hiding inside what looks like an unremarkable industrial case. Evaluation doesn't tell you what to do. It tells you what question to ask. Before the work, the only question available was, is it going up or down? A guess dressed in confidence. After the work, the question becomes, is what I'm paying less than what this is worth? And by how much? A discipline dressed in honesty. Most investors spend their entire lives in the first question. The second one is available to anyone willing to do the work. Now we go back to the investor who lost everything. He wasn't wrong about the story. Let's be clear about that. Clean energy was a real sector. The energy transition was a real trend. Evergreen Solar was a real company, making real products for a market with real demand. The company had grown its revenue 40% a year for 4 straight years, the kind of growth that makes investors dream, the kind of track record that feels like evidence, and he still lost almost everything. Here is why. A story being true and an investment being sound are two completely different things. Most people treat them as the same. They are not. The story tells you what the company is trying to do. The valuation tells you what succeeding at that actually requires. In cash, in time, in margin, in survival, and whether the price you're paying assumes they've already done it. Evergreen Solar was losing money on every dollar it earned, not by a little, by more than half. To turn that around, the company needed to scale fast enough to build cost advantages, improve its economics far enough to reach profitability, and stay alive long enough to get there, all while Chinese manufacturers were entering the same market with cheaper panels and more capital. That is not impossible. Companies have done it, but the price the market was charging assumed it would happen, without much question, without much discount for the very real chance it wouldn't. The honest accounting of what that company was worth, factoring in what success required and what failure looked like, said 42 cents. The market was charging $2.70. Evergreen Solar filed for bankruptcy in 2011. The investor was right about the story. He was wrong about the question. The story answers, what is this company trying to do? The valuation answers, what does trying require? And what happens if they don't make it? He never asked the second question. Almost nobody does. There is a moment in almost every investor's life when they find a company they believe in. Real product, real customers, real growth. The kind of brand that feels inevitable. The kind you can see winning. Under Armour was that company for a lot of people. Kevin Plank built it from nothing. It grew fast, earned its customers, and took market share from giants who had been dominant for decades. And when investors bought it, they felt like they were making a smart decision. A grounded one, not a bet on a rumor. A bet on a company they had watched prove itself. Here is what nobody told them. Every price you pay for a stock is a bet on a specific future. Not this company will do well. A specific future, a particular size, a particular market position, a particular set of margins that has to arrive for the price to make sense. Most investors never ask which future their price is betting on. They don't know they're being asked to bet on one. Damodaran looked at the price the market was charging for Under Armour and worked backwards. He valued the company honestly. the cash it was producing, the growth it could sustain, the risk it carried. He arrived at a value of around $26 per share. The market was asking nearly twice that. Then he asked the harder question, what does a price that high require Under Armour to become? The answer was uncomfortable. At the price the market was charging, Under Armour needed to capture global athletic apparel market share at a scale that would put it in sustained, head-to-head competition with Nike. Across geographies, it had barely entered. In categories it hadn't yet built, faster than almost any brand in the history of the industry had done it. The company was real, the brand was real, the growth was real, but the price was betting on a version of the future that might take 20 years to arrive, or might never arrive at all. Most of the people buying didn't know that was the bet they were making. Here is the question that protects you. Before you buy anything, ask, what does this price require this company to become? Then ask whether you actually believe that company becomes that thing. If the answer makes you hesitate, pay attention to the hesitation. It's telling you something the price isn't. Not every dangerous assumption looks dangerous. Some of the most expensive mistakes in investing are made on the most boring companies imaginable, because boring feels safe, and safe feels like it doesn't need to be questioned. Hormel Foods, canned meat, peanut butter, turkey, a company that has been public for nearly 80 years, paying dividends without interruption, growing slowly and predictably year after year. An analyst runs the numbers, takes the recent growth rate, applies it forward, plugs in the standard discount rate. Everything looks exactly the way it's supposed to look. The model says Hormel is worth $115 per share. The market price, $32, a 262% undervaluation. In spam. Something is badly wrong. But the wrong thing is invisible, hiding inside a number that looks completely reasonable. Here is what nobody checked. If Hormel grows at that rate forever, Hormel grows faster than the entire American economy, every year, permanently, not by a lot, just by enough that, over decades, Hormel becomes an increasingly large fraction of everything, from canned meat and peanut butter. And there is something worse underneath that. For that growth to produce those cash flows, Hormel has to earn a return on every dollar it reinvests of 34.5%, forever. A return that almost no consumer goods company in history has sustained, not for a decade, not briefly, forever. For processed meat, nobody questioned it. The assumption looked normal. Normal-looking assumptions, left unexamined, produced a number that was pure fiction. The most dangerous mistakes in evaluation are not the aggressive ones. Everyone scrutinizes the aggressive assumptions. The dangerous ones are the ordinary ones, the ones that feel so reasonable that nobody thinks to test what they're quietly implying. The word stable is where investors go to sleep, and that is exactly when they should be paying the most attention. Sometimes the most important thing evaluation does is force you to be honest about what you know and what you are pretending to know. 2008. Las Vegas Sands is in serious trouble. This is not a rough quarter. This is the kind of trouble where the word bankruptcy appears in board meetings, where creditors watch the balance sheet the way a doctor watches a patient in critical condition, where the company is earning less than it costs to keep itself alive. And yet, analyst after analyst is publishing price targets that assume a recovery, not a possible recovery, an imminent one. Revenue bouncing back, margins returning to historical levels, capital costs normalizing. Everything that was broken somehow fixed, quickly, completely, and without much evidence that the fixing had started. These are not reckless people. They are professionals, educated, experienced. But somewhere in the process, the model stopped describing reality and started describing a preferred version of it. Damodaran builds a different model. He starts with what is actually visible, the real numbers, the real distress, the real probability that a company carrying this much debt in this environment doesn't make it to the other side. He prices all of that in. He does not look away from any of it. His honest value, $5.89 per share, almost exactly where the market was already trading, the same level the recovery analysts were calling irrational fear. The market wasn't irrational, the recovery models were. When a company is in real trouble, there are two ways to build a model. You can build the model that reflects what is true, or you can build the model that reflects what you hope will become true. and dress it in professional language so it looks like analysis. The second kind of model is everywhere in moments of distress. It has a name that sounds rigorous. It has tables and projections and discount rates. But underneath all of that, it is still just hope. And hope has never been a line item in evaluation. There is a type of mistake that doesn't come from bad analysis. It comes from applying good analysis to the wrong kind of company. Banks are the most important example. Here is a thought experiment. You have money in a savings account, $10,000. From the bank's perspective, that money is a debt. They owe it to you. It's a liability on their books. Now imagine someone tries to value that bank the same way you'd value a manufacturing company, counting all those deposits as debt, treating them the way you'd treat a bond or a loan. Suddenly, the bank looks terrifyingly over-leveraged, 90% debt, a sliver of real capital holding everything together. The model says, impossibly cheap. The model is wrong. Not because the math is wrong, because the frame is wrong. For a bank, deposits are not how you finance the business. Deposits are the business. They're the raw material, the thing you take in and transform into loans and earn a living from. Treating them like debt is like treating a bakery's flour as a liability. Technically accurate on one level, completely misleading on the level that matters. So analysts use a different approach for banks. They focus on what actually reaches the shareholder, the dividend. Wells Fargo was paying a regular dividend, had been for years. Discount that dividend forward at the right rate, and the model says Wells Fargo is worth nearly $27. The market was charging $16. Generational opportunity, buy, accept. In 2007, Wells Fargo earned $4.47 per share. In 2008, that number had fallen to $1.71, and it was still falling. The bank was paying out almost everything it earned in a crisis, with earnings in free fall. That dividend was about to be cut. Anyone looking honestly at those two numbers, 447 becoming 171 in a single year, could see what was coming. The model couldn't see it, because the model was built on history, and history had just stopped being a reliable guide to the future. The frame was right for banks in normal times, but these weren't normal times. And a frame that can't see what's changed in the environment it's looking at isn't analysis. It's a mirror pointed at the past. What Wells Fargo teaches isn't about banks. It's about the cost of using the right tool in the wrong moment. The framework you bring to a company determines what you're capable of seeing. And if the world has changed faster than your framework has, you will confidently see something that is no longer there. There's a language we use to measure businesses. It has rules, standards, refined over decades to make companies comparable, their numbers auditable, their reports trustworthy. It is also in certain ways blind, not deliberately, not through fraud, just through the limitations of any language. It can only say the things it has words for. And the most valuable things built by the most valuable companies in the world today are things accounting doesn't quite have words for. Think about what a pharmaceutical company does. It spends a decade developing a drug, billions of dollars, thousands of scientists, years of clinical trials, regulatory review, uncertainty about whether any of it will ever reach a patient. And if it works, if that drug gets approved and reaches the market, it may generate revenue for 15, 20 years, a genuine long-term asset built over years of commitment. Here is what accounting does with that investment. It erases it. The moment the money is spent, it disappears, expensed, gone from the balance sheet as if it never happened. The drug under development doesn't exist in the official record. The decade of scientific work that created it doesn't appear as an asset. The compound in phase 3 trials is financially invisible. Amgen had built one of the great scientific enterprises in the history of biotechnology, blockbuster drugs, a research pipeline that competitors would spend billions to replicate, decades of accumulated expertise sitting inside its walls. Under conventional accounting, it looked like a reasonable business, fairly priced, nothing remarkable. Damodaran made one adjustment. He treated the research for what it actually was. Not a cost that disappears each year, but an investment that accumulates. Because a drug developed over a decade is not an expense from this year. It is an asset being built across a decade. That single change moved the estimated value by more than 30%. Same drugs, same revenues, same scientists, same future. $44 under the old language, $63 under the honest one. Different language, Completely different answer. Now think about the most valuable companies in the world today. Their most important assets don't appear on any balance sheet. Research pipelines, engineering talent, proprietary data built over years, brand equity that took decades to earn. Accounting calls these costs. They disappear in the year they're spent. What remains on the balance sheet is the shell of the business, the physical things, the things that can be touched and counted, the things that actually make these companies extraordinary, invisible. A valuation that can only see what accounting shows isn't conservative. It isn't careful. It is blind to the most important things in the modern economy. We started with a man who bought the right story. The company was real. The trend was real. The future he believed in was, in most of the ways that matter, true. And he lost almost everything. Now you know why. Not because he made a careless decision, because he was asking the wrong question. The market offered him a price, and he evaluated that price against the story. He never evaluated it against the value. 7 companies, 7 different traps, and underneath every single one of them, the same gap between what the market was pricing and what the business was actually worth. At 3M, the gap was $8, small enough to walk away from, large enough to teach the discipline. At Evergreen Solar, the gap was 6-1, hidden inside 4 years of real growth that made the story feel unquestionable. At Under Armour, the gap was invisible because nobody had asked what a price nearly double the fundamentals was actually betting on. At Hormel, a single ordinary assumption, unchallenged, invisible, seemingly safe, quietly implied that a company selling canned meat would outgrow the entire American economy. At Las Vegas Sands, the gap was the distance between what was real and what analysts desperately hoped would become real. At Wells Fargo, a framework built for normal times looked backwards into a crisis and saw something that was no longer there. At Amgen, a language that cannot say the word research asset made the most important part of the business disappear. One cause. Every time, the same cause, the wrong question. The right question has 3 parts. What does this company actually earn? How fast will that grow? And how certain are you that any of it arrives? Those 3 questions, not asked honestly without the story interfering with the math, are a valuation, not a prediction, not a guarantee, a discipline, a way of seeing that the investor who lost everything never had, not because he wasn't capable of it, because nobody taught it to him. This book is the teaching. And what you now have, if you stayed with this video to the end, is the question, the one that changes everything. 3 questions before any investment, every time. What does this company actually earn? Not the headline, not the story. The real cash the business generates after paying for everything it needs to keep running and growing. If that number is negative or unclear, that changes everything about the risk you are taking. What does this price require? Work backwards from what the market is charging. What growth does it assume? What future does it project? What does this company need to become for the person paying this price today to not be overpaying? Then ask, honestly, whether you believe that future arrives. What is the honest risk? Not the optimistic case, not the recovery scenario. The real probability that the future being priced actually arrives, including the scenarios where it doesn't. Companies go bankrupt, dividends get cut, industries shift faster than models account for. Ignoring those probabilities doesn't make them smaller. 3 questions across 7 companies in 7 different situations. They would have changed the outcome every time. They will not make you right every time. Nothing will, but they will make you stop buying prices and start finding values. And that is a completely different way of investing. If this changed how you think about investing, subscribe to Deep Value Minds. Every week we decode the books that shaped the greatest investors in history. The next one might change everything again.